Imagine one institution in the United States influencing stock markets in Europe, inflation in Asia, and currency values in developing countries. That's the power of the Federal Reserve. In this video, we'll break down how the Fed, America's central bank, exerts such widespread control over the world economy, step by step. We will answer the question of how this one institution can sway economies across the globe and what tools they use to do so. Interest rates are the cost of borrowing money. The Fed sets the federal funds rate, which influences the rates banks charge each other and, ultimately, consumers and businesses. Lower rates encourage borrowing and spending, while higher rates encourage saving and slow down economic activity. The federal funds rate influences prime rates, mortgages, and credit cards. Balancing growth versus inflation is key. Rates that are too low lead to bubbles, and rates that are too high slow growth. For example, a mortgage rate drop from 7% to 5% saves about $200 per month on a $300,000 loan, encouraging more home buying and economic activity. Looking at historical data, interest rates have fluctuated over decades, from highs in the 1980s to lows in recent years, always aiming to keep the economy balanced. When the Federal Reserve raises interest rates, borrowing becomes more expensive across the economy. Imagine a family planning to buy a home. Their mortgage payments would increase, making them think twice about spending. This slows down consumer spending overall, which can help cool down inflation by reducing demand for goods and services. Higher rates also attract global investors seeking better returns on U.S. bonds, strengthening the dollar. For example, watch how the USD/EUR exchange rate climbs, making U.S. exports more expensive for European buyers, but benefiting American companies importing goods. On the flip side, when the Fed cuts rates, borrowing becomes cheaper, encouraging spending. A business might take out a loan to expand, or consumers could refinance homes, injecting more money into the economy and potentially stimulating growth. Lower rates can weaken the dollar as capital flows out to higher-yielding opportunities elsewhere, like emerging markets. Notice the exchange rate dropping, which might make U.S. goods cheaper abroad, but raise import costs at home. These rate changes create worldwide ripples, affecting exchange rates that influence international trade, shifting investment flows that can boost or hurt economies, and altering trade balances as countries adjust to currency fluctuations. For instance, a stronger dollar might hurt U.S. exporters but help importers, while global stock markets react accordingly. Quantitative easing is like the Federal Reserve printing money to buy bonds from banks, injecting cash into the economy to lower interest rates and boost financial markets. This stimulates the economy, but if done excessively, it can cause inflation as more money chases the same goods. Imagine during the pandemic when QE helped stock markets recover, but prices rose sharply. Globally, this floods the world with dollars, potentially pushing up prices everywhere and weakening other currencies against the dollar. After peaking QE during the pandemic, the Fed tapered it in 2023 and began quantitative tightening in 2024, selling assets to reduce the money supply and balance things out. Fed actions ripple far beyond U.S. borders. When the Fed raises interest rates, global investors flock to safer U.S. assets, draining capital from other countries. This weakens their currencies, raises borrowing costs, and sparks inflation, especially hitting developing nations hard. Take the 2022 rate hikes, for example. Investors pulled money out of Turkey, causing the lira to plummet against the dollar. This made dollar-denominated debts far more expensive for Turkish businesses and the government. Developing countries like Turkey and Argentina faced soaring borrowing costs and inflation as their currencies fell. Meanwhile, stronger U.S. assets attracted funds, creating a global tug-of-war for capital. The opposite happens when the Fed cuts rates. Cheaper borrowing in the U.S. pushes money outward, strengthening other currencies and aiding growth, like India's economic boom in 2025 after Fed cuts eased dollar borrowing costs. This interdependence means Fed decisions create winners and losers worldwide. Global investors and policymakers closely watch every Fed move, as it directly impacts their economies and currencies. The U.S. dollar's status as the world's reserve currency turns the Federal Reserve's actions into a global force multiplier. Used in about 60% of international trade and held in nearly 60% of foreign reserves, the dollar's dominance means Fed policy changes don't just affect America, they reverberate worldwide. This pie chart shows how the dollar dominates global currency trading at 88.5%, far surpassing the euro at 30.5%. Such dominance stems from America's economic size, military strength, and global trust. When the Fed raises interest rates, the dollar strengthens, attracting investors and hurting exporters in other countries who find their goods more expensive abroad. A weaker dollar from rate cuts boosts global exporters by making their products cheaper. This bar chart illustrates the dollar's role in foreign exchange turnover, stable at around 88% in recent years. Because so much global trade and finance happens in dollars, Fed monetary policy changes affect every nation participating in the world economy, creating ripple effects that can cost emerging markets billions in capital outflows.